Understanding the scenario always is going to start with a timeline. So the first thing that I do, whether it's on paper or on a whiteboard, is I'll draw a timeline out for whatever's going on in the project. And rather than just putting numbers on the timeline, I tend to put labels on the timeline that mean something in plain language. So in our proposal, there are things that are going on at each of these periods. At period 0, we've got, according to our proposal, an opportunity to sell the old machine and buy the new machine and install the new machine, and there's going to be an increase in our net working capital needs. All of these are relevant to our decision because that's what happens if we engage on the project. If we engage on the project, for each of the next 5 years, we'll see a benefit in that it's going to reduce our operating costs. Now, reduction in operating costs is going to increase our EBIT. And EBIT is the basis for operating cash flow, so we're going to use our operating cash flow as kind of the starting point for our numbers that we're going to discount. So for each of the next 5 years, we've got a reduced operating cost, and then at year 5, at the end of year 5, after we've gotten the benefit in that reduced operating cost, we're going to wind up selling the replacement machine, and our net working capital needs are going to be reduced. So we'll have an additional cash flow, which is going to come from the sale of that replacement machine, and we're going to have cash freed up because we don't need that money for our net working capital needs anymore. Those are both going to be treated as cash inflows, and they'll increase that year 5 cash flow that we'll be discounting. The next step is to identify what the cash inflows and outflows are. So in order to do that, let's take a look at more information from the problem itself. Buried in that paragraph of information, we have an opportunity to sell the old machine, and it says that we'd be able to sell it for $185,000 before taxes. In order to figure out what our gain is going to be from that, we're going to look at whether we take a gain or a loss on the sale of that asset. So we'll be looking at what the proceeds are, the $185,000, minus the book value, whatever it's on the books for at the time. In this case, it was on the books for $384,000. Which means we've taken a loss on the sale of this equipment. We only got $185,000 in cash coming in, but it was on the books for $384,000, so we're writing off the rest of that. We're writing off that $199,000 leftover amount. However, that loss gives us a tax benefit. What we're going to do next is look at the tax effect of that sale. Because we had a loss, our tax effect is going to be a negative number. In other words, it's going to reduce our tax obligation as a result of taking that loss. We're given an additional write-off on our taxes that's going to give us $79,600 in benefit when it comes time to pay our taxes. So we had a $199,000 loss. We multiply that by the tax rate that's appropriate, 40%, and we're left with whatever our tax effect is going to be. The tax effect in this case is going to be $79,600. So the after-tax proceeds is going to be whatever we brought in from the sale of that machine, the proceeds that we have, minus the tax effect. In this case, our tax effect is negative, and so our after-tax proceeds are larger than the cash that we brought in for the machine. We sold it for $185,000, and it's actually going to give us a benefit of $264,600 because we're subtracting that tax effect from it. The initial investment is going to also include the purchase of the new machine. Now, the acquisition of an asset has to include whatever we're paying for the asset, and it has to include any costs associated with getting that asset ready to generate future cash flows. We can't use the machine without installing it, so we've got $150,000 in installation costs that are relevant. So we take the $1.2 million, and we're going to add to that the $150,000 of installation costs. So our total cost for the new machine is going to be $1.35 million, $1.2 million plus the $150,000. In addition to that, in our initial investment, we're going to have another $25,000 in increased net working capital needs. How do we cherry pick that out of the paragraph? If we know what we're looking for, it's easy to come up with what the pieces should be. And so it's good to have some sort of a framework to work with. Using the templates that you could build from the slides, you'd be able to make a sort of a checklist of what you should be looking for. The sale of the old machine is going to be something that you can find in there. The existing machine can be sold for $185,000 before taxes. It talks about what the the book value is, $384,000. So that information is all there. It talks about the cost of the new machine being $1.2 million and requires installation costs of $150,000. So that information is there. It talks about an increase of $25,000 in net working capital, about 3/4 of the way through the paragraph. So it talks about that. It identifies the tax rate, which is relevant to our computations. So we're able to look at this paragraph and find the things that we need, provided we know where to write them down. So when we're starting to figure out the cash flows associated with a project, we want to have some sort of a checklist. Use the template that you could build from the slides in order to develop that checklist. The next thing we want to do is to figure out what the terminal value is going to be. If we have the initial cash flow involved in the project, we also want to know what the cash flow is going to be at the tail end of the project. So the terminal value is whatever remaining value a project has after the intermediate cash flows have all happened. There are different labels that are used for terminal value. Sometimes it's called residual value. On a capital project, it might also be called salvage value. We might be discussing what do we expect to be able to sell this piece of equipment for at some time in the future. If we're talking about a business operation, it could be that we're looking at selling that business operation to outside investors at the end of its life, or it could be that we're looking at the overall value of a business enterprise. A collection of all of the things that the business does is going to be the enterprise value, and we'd be looking at whatever the residual value is from that ongoing business. In our case, however, I'm just going to call it terminal value. Now, the details around the terminal value shown in the paragraph for the problem include selling the new machine or the replacement machine after year 5. This is going to be something that they're expecting to be able to sell for $200,000 before taxes. Until they actually sell it, we don't have any better information, so we're going to use that in our forecasts. And we need to figure out whether we're expecting to take a gain or a loss on the sale of that replacement asset. So once again, we go through the same process we did before. We'll look at the proceeds minus the book value to determine if we had a gain or a loss, and then we'll look at the tax effect, and we'll subtract the tax effect from the proceeds to see what our after-tax proceeds are. The book value of the equipment is going to wind up being $67,500 at the end of year 5. If we're expecting to sell it for $200,000, we'll take the $200,000 minus the $67,500 to come up with a gain of $132,500. Because we have a gain on the disposition of the asset, we'll be paying taxes on it. So our tax rate times that gain is going to give us $53,000 in tax effect. In other words, the company's tax bill is going to be $53,000 larger because of the gain they made on the sale of that equipment. So the after-tax proceeds of the replacement asset are going to be $200,000 minus $53,000 in tax effect. The net after-tax proceeds are going to be $147,000. The other thing that goes into our terminal value is going to be the return of any net working capital. We have cash flow which is freed up for the parent company because they don't need to run this operation anymore. So that $25,000 that we put in up front is going to be something which comes back to the company when they close down this project. Figuring out the book value of the machine after that 5th year involves understanding what's gone on with depreciation. So we're going to be working with makers as a basis for our depreciation. The base cost for makers is going to include our cost plus our installation costs. So the machine itself was selling for $1.2 million, plus we had a $150,000 installation expense. So the total cost that we're dealing with for the base of our depreciation is $1.35 million. It's a 5-year asset, so we're going to use the 5-year column there. And the first number that we see in the 5-year column is 20%. Our recovery year, number 1, is going to have a 20% depreciation. It's going to be 20% of the $1.35 million. 20% of $1.35 million is $270,000. So the first year depreciation is $270,000. The second year depreciation is going to be 32% of the same amount that we used before. So it's going to be 32% of the $1.35 million. 32% works out to be $432,000. Year 3 we have 19%. 19% times $1.35 million is $256,500. Years 4 and 5 use 12% for depreciation. So 12% of $1.35 million is $162,000. At the end of that time, we've depreciated 95% of this piece of equipment, and we've got $67,500 left. There are 2 ways to compute that $67,500. We can start with the $1.35 million, and we can subtract out each year's depreciation from it. We'd be left with 67,500. Or we can take the percent remaining, that 5% that remains after that 5th year, multiplied by 1.35 million is going to be also 67,500. When you're trying to figure out what the book value of the machine is going to be at the end of that time, sometimes it's easier to take that shortcut and look at what percentage is left in our depreciation formula and multiply the cost of the machine times that. However, we are going to need these depreciation figures when we're figuring out what our relevant cash flows are, so ultimately you have to do both.